Well, welcome James Holt from BlackRock Investments. Let's take a closer look at the Global Allocation Fund, which was set up right after the 1987 share market crash, and 22 years on we're in the middle of yet another financial market crash. So James, what's the rationale behind the fund in terms of investment strategy?
Well, exactly as you pointed out, this fund was originally set up after the 87 stock market crash because at the time we found clients wanted to be invested into equity markets when they were going up, when they were heading in the right direction. But of course, when equity markets are challenged, when they're in outright decline, they wanted to have some level of protection. And that doesn't mean putting the whole portfolio into cash or bonds, but they wanted to have some bit of protection there to sort of preserve capital on the way down, so that we would sort of start from a higher base when the share market inevitably recovered, and we could invest again in equities and experience some good performance.
Now, up until December 2008, the fund was mainly investing in international equities, fixed interest and cash. Has anything changed within the portfolio over the last few months, and if so, why?
Not dramatically. This fund is a long-term strategic fund. It tends to move at a pretty glacial pace in terms of turnover. As of the end of the year, we were about 50-55% invested in shares. We did have about a 30% allocation to global bonds, mainly treasury bonds, so the safe haven of government bonds, about 13% cash as well. And that sort of provided the protection as share markets were falling. And then obviously we use that as a funding source, the bonds and the cash, to move into shares, to move into corporate bonds and things like that, which are also, like shares, can go up dramatically as an economy recovers, so that we can start to generate gains again.
Well, as you know, we've seen a lot of volatility over the last year or so, and now literally trillions of dollars pumped into the US economy in a bid to rescue the ailing banking system. Has that tempered your decisions in any way?
No, I think the key thing is your point is absolutely well taken, and we obviously do see risks down the track that the amount of money being pumped into the economy by the Federal Reserve, by the Treasury, could potentially create inflation. You won't hear a lot about that this year. The focus will be very much more on preventing the economy from falling into deflation. But in a year's time, in 2 years' time, the difficulty will be how quickly does the government withdraw the stimulus that they put into the economy, and if they get it wrong even by a slight amount, that may result in significant inflation. So for us, we've invested in things like Treasury inflation protected bonds. We do have an allocation to gold. They're sort of very, very important assets to have in the fund to protect against inflation down the track. And I think that the attitude that investors have got to take is that whenever assets sell at these incredibly low values like they are now, and they represent good value for money, you want to be invested, but you want to take out some portfolio insurance. That's our attitude. You don't want to be completely invested in cash. You want to be invested in the markets, but you do want to take out some insurance against the potential for inflation to come back.
Okay, taking a step back, how has the fund performed since its inception?
In terms of saving capital and putting it into the markets when they're running again, we've been able to perform very well. So, for example, since inception, 2004, the fund has returned about 0.5% per annum in a very difficult environment. But the share market per annum over that period has gone backwards at by about 9%, or a bit over 9% per annum. So clearly, we've sort of prevented clients from experiencing the worst of that downturn, and instead, as we can shift assets back into the market again, we can start from a higher base.
So what should investors be factoring into their investment strategies right now? There are clearly a lot of questions being asked as to whether or not this is the time to buy.
Exactly, and I don't think investors can ever really get the exact bottom of markets. They're always difficult to pick at the time. Everyone knows them very well in hindsight, but because markets are volatile around these levels, the market will tend to recover about, based on past history, maybe about 3 to 6 months before the economy ceases to be in recession and starts to grow again. So the difficulty will be when people feel bad about the economy. Ironically, that'll be a good time to be invested in the share market. So they've got to bear that in mind for a start, is that it'll feel like a bad time to invest, but it's actually a good time from an asset point of view. The other thing as well is they'll also want to be investing, I think, not just in stocks this time around, but also you can buy a shareholding in a company, you can also buy a share of the company's debt. That's the corporate or credit market. And not only do shares represent outstanding value right now, but corporate debt represents the best buying opportunity in about 70 or 80 years, and we're acutely conscious of that. And as we're shifting money out of cash and out of the safety of government bonds into those sort of assets, we're buying corporate debt as well as equities. So they provide a bit of extra dazzle, hopefully, to investor returns as we emerge from recession.
So is now the time to be courageous then?
I think people should look at averaging potentially. It depends on their circumstances. They should always seek financial advice for their personal circumstances, because where they are in life, if they're about to retire, all those things will have an enormous impact on whether or not they should be investing. But again, I think a critical thing from a psychological point of view, rather than sort of trying to put everything on one particular date, averaging into markets makes a lot of sense from a psychological point of view, but it's a very legitimate investment strategy. Why put all your eggs in one basket or put it all on one date when you can instead, as you see markets are around about achieving some sort of bottom, you can average your capital into those markets and get a share of that bottoming process, even if you can't pick the absolute day on which the market is at the absolute nadir.
As you know, the Australian economy and other Western economies are under enormous pressure at the moment. How do you see that playing out, and what impact will all this have on the fund?
I think a couple of interesting things. We're very heavily invested in Asia, in Japan, and also Asia outside of Japan. We see that very much as the future of the global economy. That's not to say that United States stocks don't represent good value. They do, but we see more compelling value in other parts of the world. So we do own some US shares, but we also own shares outside of those places where we see the emerging economies of the world becoming the giants of tomorrow. But again, even in the case of the United States, it will experience a very rough patch over the next 2-3 years. It'll be in recession through the rest of this year. It'll be a very slow recovery, but there are a few good opportunities there even in that market.
And finally, what's your investment outlook over the next 12 months?
We think that markets have started to enter some sort of bottoming process that could continue for some time. We do expect a lot of volatility over the next 6-12 months, but we just bear in mind that the actual recession itself will probably last for the rest of this year. It's always been going to be a much more significant recession than people believe. It will be an outright recession in the US this year. The growth next year will be very, very slow. But again, we just have to remember that markets, on average, tend to bottom before the economy actually does. So sometime maybe in the latter half of this year, we'll start to see a recovery in markets, even though the economy itself is still in recession. And that recovery should hopefully continue through as the economies start to grow again next year.